Okay, we'll continue discussing the finances, and now we're going to talk about the balance sheet. Now, before I start discussing the balance sheet and the details of the balance sheet, I'd like to summarize what we've done so far. So, if you think about the income statement and the profit and loss statement, it shows and reflects how efficient the company is in its business operations. Okay, it shows the profits, it shows the losses, it shows the costs, and how well it is at generating and retaining the profit within the company. Now, if you think about the cash, this is about how liquid the company is. So cash is the most liquid asset. And what investors ultimately want from the companies, they want it to be efficient and have a lot of loss and have a lot of profit, but they also are very interested and worried about how well the company can actually pay dividends, how well and how fast it can actually pay off all the liabilities, обязательства. And this is related to the cash. So the cash flow actually shows how the company is liquid, to what extent it's liquid. Okay, so how fast it can actually pay off all the dividends, all the liabilities. Now, how about balance sheet? Overall, the balance sheet shows how wealthy the company is. So balance sheet is about богатство компании. So yes, you generate profits, then you optimize the costs, and you have lots of retained profit, you have lots of dividends, and so on and so on. You have lots of cash. But again, these, if you notice, these income statements and cash flows, they do not actually show the accumulated wealth of the company. So this accumulated wealth of the company and in a time period should be reflected somewhere, and this is called balance sheet. So the balance sheet is about reflection of the wealth of the company. Now, let's take a look at these ones. Now, for the simplicity, I'm going to start with a very simple example of a physical person's example. His name is Sanchez. So Sanchez seems to have to own some physical assets. We call them assets, okay, like house, for example, which worth $50,000. He also has some car which he can sell at $4,500. He has some savings. He has some saving in his bank account. So the total wealth so far of Sanchez is equal to $58,000. But unfortunately, Sanchez also has some debts, some liabilities. In a corporate term, in a physical term we call it debts. So how much Sanchez owes to somebody, but in a corporate language we call it liabilities. Okay, so in corporate term, something that you own, we call them assets. Okay, and something that you owe, not own but owe to somebody, in a corporate language we call it liabilities, обязательства. Now it seems that Sanchez has some loan, mortgage, ипотека, and then bank loan on the car. So it seems that he hasn't paid out to the bank fully for his car, and he owes to his brother some amount of money. So if we calculate the total sum of his liabilities, how much he owes, then it accounts to $22,500. Now, in a finances, it's pretty much important not just to know how much you have, but actually also take into account how much you owe, and actually know the net, the difference between how much you own and how much you owe. In the corporate language, we call it equity. Okay, equity. Now, it seems that the difference between the total assets and total liabilities of Sanchez is equal to $35,000, $35,500. So I think now, so far, it's clear. Okay, now the assets are actually divided into two: fixed assets, intangible assets, and current assets. Now, fixed assets, which are usually tangible assets, it can be the company's land, the company's offices, the company's buildings, equipment, vehicles, something that costs money, okay, a lot usually. So this is the fixed and tangible assets, as well as sometimes companies actually have some intangible assets. They do not physically exist, but they actually worth some amount of money. For example, the brand, also sometimes known as goodwill, patents, copyrights. So if you think about the intangible asset of Apple company, which so far was the most expensive company in the world, on the planet, they had a lot of intangible assets. The brand itself costs so much money. It's not on the top of my head, but I can't remember the exact details, exact figures, but it's a lot of money. The Apple brand itself costs a lot of money because this is about the customer's trust. Okay, that's why companies. That's why sometimes the startup entrepreneurs, they actually prefer to start by buying and purchasing an existing brand and operate and a franchise, because this particular brand also costs some amount of money. So I think that's quite clear, right? Between the fixed asset, tangible assets, and intangible assets. Intangible assets, they don't physically exist, but they actually worth a lot of money. Now, current assets, okay, the difference between fixed assets and the current assets, again, is in the period of time. If you do remember from our previous lecture, we said that the difference between long-term debt and the short-term debt was 1 year. So 1 year was like a threshold between the long-term and the short-term. So you can think about fixed assets as long-term assets that are very unlikely to be sold out, okay, within 1 year. Usually, I mean, obviously you can sell it within 1 year, but normally companies, they do not have them just to resell it in a very short period of time. They have it for a longer period of time. That's why they're called fixed assets. Whereas current assets, these are the assets that are going to be used up, that are going to be spent, okay, or saved, whatever, used up, in a short period of time, which is before 1 year. It can be cash. Usually companies, they do not tend to keep cash for a long period of time. They invest it, they do something with it. Inventories, obviously, hopefully you don't keep inventories for a very long time, because if you do remember, this is a waste, this is inefficiency, because it costs money to save it and keep it and store it somewhere. Accounts receivable, do you remember at the very beginning of the part 1 lecture, I told you that sometimes the net cash can be different from the profit, because you do have some receivables. Sometimes the customers, they buy the products and services on credit, meaning that they do not pay you immediately the cash, but they owe you. They say, hey, we're gonna pay you next month. Is that okay? And this is very common practice in businesses, and that's why you have to take it into account. You can't just say, well, it's nothing. You have to say it's something, right? And it's called accounts receivable. Okay. Good. So hopefully the customers will pay it off in a short period of time. Now, if we continue to look at the Amazon's balance sheet in 2018, these guys, they had a fixed assets accounting $61 billion US. Intangible assets. Okay, intangible assets, as I said before, surprisingly is also an immense amount of money, which is barely $19 billion US. Okay, so these guys had a lot of worth in the intangible, non-physical assets as well. Now, the second part, if you do remember, the Sanchez owed somebody, and in business and corporate language we call it liabilities. Now, liabilities is also divided into two, non-current and current. Non-current liabilities are also long-term borrowings that do not have to be paid within 1 year, but more than 1 year. It can be bank loan. If you do remember, the bank loan was classified as a long-term borrowing because you usually pay off the loan for more than 1 year, whereas the overdraft was classified as a short-term borrowing because overdraft needs to be paid within 1 year. Now, current liabilities are those liabilities that you have to pay off within 1 year, like a bank overdraft or payables. So there are receivables from the customers, and sometimes you do not pay the cash to your suppliers, but actually you take it on credit. You say, hey, dear partner, dear supplier, I don't have the cash right now. Can I pay you next month or so? And sometimes the suppliers, they do provide the products, the supplies on credit. And in this case, you have to record it under current liabilities, and specifically, this is called payables. Now, the difference between total assets and total liabilities is owner's equity. This is your net worth. Good. So let's talk about these. So let's kind of summarize what we've just discussed so far. Now, if we think about assets, again, we have non-current and current assets. Non-current assets, there's a fixed and tangible assets like land and building. There are some current assets like cash and inventory, accounts receivable, and total assets. You sum up the current assets with non-current assets. Whereas liability is also divided into two, current and non-current. So current liabilities, accounts payable, as I said before, bank overdraft that you have to pay before 1 year. And then there are some longer term liabilities like bank loan. And then the equity is going to be equal to the difference, the net, the difference between the total assets and the total liabilities. Okay. Now, analysis. Analysis is very important. So, okay, you look at the financial statements, and if you are to invest into company stocks, for example, into the stock market, and then if you're deciding which companies to pick up to your profile, then you want to know how efficient they are, and you actually want to compare. As I said before, there is barely any company that has exactly the same metrics, that has exactly the same figures. That's why the absolute figures are sometimes not very useful, because the larger company will have more revenue, the smaller company has slightly less revenue, and so on. That's why you want to actually look at the ratios, at the multiples. Okay, so now we're going to talk about ratios, these multiples. Yeah, and again, it's actually a very good tool to monitor the performance from the past to now, and performance of compared to other businesses. Okay, liquidity. I've already mentioned that term particularly. Now let's talk about one very commonly known widespread multiple, which is called ROCE, return on capital employed. Okay, return on capital employed. Now let's say that you do have some net profit this year, and how much capital you actually employed, how much capital you actually used to generate this net profit in percentage. So the higher the percentage, the better. That means that company is very good and very efficient in utilizing this capital and generating the maximum profit. Gross profit margin, this is simply the ratio between the gross profit and the sales revenue. Net profit margin is the ratio between net profit and the sales revenue. Now, what is the difference between gross profit margin and net profit margin is given in the formula, numerically, no problems. But why do we need both, right? That's the question. Now, they actually reflect two different things. They do tell you two different things. If the gross profit margin is high, okay, that means that the cost of goods sold are low, and you're doing well in this particular case, that you're very good in minimizing the cost of goods sold. Now, if the net profit is low, and let's say that the same company has high gross profit, but then ultimately it has very low net profit compared to other companies, that means that you do have a lot of indirect expenses. Sometimes they're called overheads or fixed costs. Now, in this case, you might think about to optimize and reduce your costs in indirect costs, like maybe you're hiring too many people, or you do have a lot of fixed costs. Okay, so in this case, the net profit margin gives you a different idea on what to do with this particular situation. Now the liquidity test. Now the ratio between current assets and current liabilities is known as liquidity test and current ratio. Now we actually prefer to increase the current ratio because you don't want to have a lot of liabilities, but you rather want to have a lot of assets compared to liabilities. But then the question would be, is it good to have zero liabilities and only current assets? Well, it's yes and no, because sometimes businesses, they may actually generate more profit when they borrow some money as if compared to those money that you only have within your company, which is limited amount of money. So sometimes the rationale why companies, even wealthy companies, still borrow some money from external just because they want to increase the profit, the earnings by the end. But as we all know that the higher the risk, the higher the profit and revenue, the higher the risk. So if you want to earn a lot of money, that actually has a lot of risk at the same time, because liability by default is liability and you have to pay it off eventually. Now, asset test is another metric, is another ratio. It just excludes inventory. Okay, that's it. Now here we have summarized those ratios that we have just discussed. So guys, these are not the only ratios, by the way. There are tons of ratios that you may want to use in different cases, and all these ratios, they will actually mimic different things depending on what you're looking for. Good. Stay safe. Look at Investopedia, which is a very good source. By the way, we usually do not advise on some web resources, but I found that Investopedia is very handy, very simple to use, and a lot of savings in time source. Okay, so chapter 23, 24, and 25, and Investopedia is something that we would like to advise.